All right, let's dive into this question. Imagine you are in the shoes of Auditor Neon, and you've been tasked with reviewing a cash flow forecast. Now, when we talk about forecasts, we are dealing with the future, and the future is always based on estimates. So, as an auditor, your goal isn't to predict the future, but to ensure that the process used to create that prediction is logical and reliable.
There are two critical procedures Auditor Neon needs to perform here. First, we have to evaluate the reliability of the underlying data. Think of this as checking the foundation of a building. If the historical data or the current figures used to build the forecast are incorrect or manipulated, then the entire forecast is flawed. Neon needs to verify if the data is accurate, complete, and comes from a dependable source.
Second, and perhaps even more importantly, Neon must determine if there is adequate support for the assumptions underlying the forecast. Every forecast relies on assumptions. For example, assuming a 10% increase in sales or a specific timing for tax payments. Neon needs to ask, why was this assumption made? Is it based on market research, past trends, or just a wild guess? If the assumptions are overly optimistic without any supporting evidence, the forecast cannot be relied upon.
So, to summarize for your exam, focus on these two pillars: the reliability of the data and the validity of the assumptions. Master these and you've got this.
All right, let's dive deep into this case study. Imagine we are presenting to the board of Mercury Limited. The CEO wants to move beyond just numbers and show the world how the company creates value in a holistic way. The CFO has suggested integrated reporting, and as consultants, our job is to break this down simply.
Now, to understand integrated reporting, you need to master the concept of the six capitals. Think of these not just as assets, but as the different resources the company uses to create value.
First, we have financial capital. This is the most familiar one. It is the pool of funds available for production, whether it comes from debt, equity, grants, or the money generated from daily operations. Next is manufactured capital. Think of this as the physical, human-made tools of the trade. We are talking about the buildings, the machinery, and the critical infrastructure like roads or water treatment plants that allow the business to function.
Then we move to natural capital. This is everything provided by the earth. It includes the water, land, minerals, and forests the company uses. It is crucial to remember that the company's activities can either protect or deplete this capital, and that impact must be reported. Fourth is human capital. This isn't just about having employees, it is about their skills, their experience, and their motivation to innovate. It covers how well the team aligns with the company's ethical values and their ability to execute the overall strategy through collaboration and leadership.
Fifth, we have social capital. This is all about relationships. It is the trust and loyalty built with customers, suppliers, and the community. In the professional world, we call this the social license to operate. If the community doesn't trust Mercury Limited, the business cannot thrive. Finally, we have intellectual capital. This is the secret sauce that gives a company a competitive edge. It is the combination of research and development, innovation, and the specialized knowledge that determines the company's future earning potential.
So when you explain this in your exam, remember that integrated reporting isn't just a financial statement. It is a story of how these six capitals interact to create long-term success. You've got this.
All right, let's dive into this important concept regarding consolidated financial statements. Imagine our auditor, Neon, is wrapping up the audit for Mars Paints and Chemicals Limited. Now, as an auditor, you can't just rely on your own testing. You need formal, written confirmation from the management of the parent company. This is what we call written representations. Think of these representations as a formal safety net. Neon needs the management of Mars to put in writing that the information provided is complete and accurate.
First, the completeness of components. Management must confirm that every single subsidiary or associate that should have been included in the consolidated statements has actually been included. No hidden companies, no missing entities. Second, let's talk about segment reporting. The auditor needs a written confirmation that the management has correctly identified the reportable segments. This ensures that the business is being broken down into the right operational pieces for the stakeholders to see.
Third, we move to related parties. This is a high-risk area. Management must represent that they have identified all related parties and all transactions that happened with them. This prevents any secret deals or conflicts of interest from slipping through the cracks. Finally, we look at the consolidation adjustments. This is the technical heart of the process. Management must confirm that all adjustments, whether they are permanent or for the current period, are appropriate and complete. Most importantly, they must confirm that all intragroup transactions, like sales between the parent and the subsidiary, have been properly eliminated, so the group doesn't artificially inflate its numbers.
If you remember these 4 points, completeness of components, segment identification, related party disclosure, and the accuracy of consolidation adjustments, you've got this topic completely covered. Keep pushing forward, you're doing great.
All right, let's dive deep into this case study. Imagine we are looking at the firm managed by partner Helium. He is conducting an annual review to ensure the firm's independence is rock solid. This is a classic exam scenario where you need to identify specific threats to independence. Let's break these 6 observations down one by one so you can master this for your finals.
First, we have partner Jupiter. He is performing both the statutory audit and a non-audit engagement for the client, Mars. Now, think about this logically. If you prepare the accounts or provide a service and then audit your own work, you are essentially checking yourself. This is a textbook example of a self-review threat.
Next, look at partner Magnesium. He is doing a tax audit for Venus, but here is the catch. He has a material, significant indirect financial interest in that client. When a partner has a financial stake, their objectivity is compromised because they want the client to succeed for their own gain. This is a clear self-interest threat.
Now let's look at the Chennai audit. The client there paid for the air travel and hotel stays, not just for the audit team, but for their family members as well. When a client provides lavish gifts or covers personal expenses, it creates an overly close relationship. This is what we call a familiarity threat.
Moving to the fourth point, we have Planet Neon. The management here is threatening to replace the auditors because the team is insisting on a provision for expected credit loss. Whenever a client uses pressure, threats, or coercion to influence the auditor's judgment, we are dealing with an intimidation threat.
Then we have partner Nitrogen. He audited Planet Oxygen and then stepped in as an arbitrator to settle a dispute between the client and a vendor. By acting as an arbitrator, the auditor is essentially promoting or defending the client's position. This shifts the auditor's role from an independent observer to an advocate, which is why we classify this as an advocacy threat.
Finally, partner Nitrogen again accepts a tax audit for Planet Argon, but the management agrees to pay a contingent fee. A contingent fee means the payment depends on the outcome of the audit. This creates a direct financial incentive for the auditor to potentially overlook things to ensure the fee is paid. This is another instance of a self-interest threat.
And that is how you dissect this case. Just remember to link the specific action, like a financial stake or a threat of replacement, to the corresponding category of threat. You've got this.
All right, let's dive deep into this case study. Imagine you are the engagement partner at Mercury and Company, and you've been appointed as the principal auditor for Venus Limited, a massive, aggressive conglomerate. Now, the core of this problem isn't about the audit of a single company, but about the boundary of a group audit. In the planning phase, everything seemed fine. You had your list of subsidiaries and associates, and you were following standard on auditing 600 perfectly.
But as we hit the execution phase, the plot thickens. The management is distracted by a big tech acquisition, and the CFO is being very casual, claiming that some entities are in and some are out. But it doesn't really matter for the final numbers. As an auditor, that phrase, "it doesn't really matter," should be a huge red flag. When you spot references to things like Project Oxygen and Element Alpha in the board minutes, things that weren't in your original list, you realize there is a high risk that some components have been omitted.
So the big question is, how do you ensure the group boundary is complete? You can't just rely on what management tells you. You need a systematic approach to hunt for these missing pieces. First, go back to basics. Review your working papers from previous years. This gives you a baseline of known components. Second, don't just look at the list, look at the process. Review how the parent company itself identifies its components. If their internal process is flawed, your list will be flawed. Third, have a direct, formal inquiry with management. Ask specifically about new additions or any entities that were dropped.
But remember, inquiries alone aren't enough. You need to verify. This is where you review the investments of the parent and its existing components. By tracing the money and the shareholding, you can find hidden entities that management might have forgotten to mention. Next, cast a wide net. Review all joint ventures and joint arrangements. Sometimes, complex structures hide components under the guise of arrangements rather than formal subsidiaries. In fact, specifically look for any other arrangements the parent has entered into that aren't currently in the consolidated statements.
Now, for the most concrete evidence, the statutory records. Dive into the registers maintained under the Companies Act, specifically those tracking loans, guarantees, and investments. These legal registers are much harder to manipulate than a casual list provided by a CFO. Finally, track any changes in shareholding that happened during the year. If the parent bought a majority stake in a new company halfway through the year, that entity must be brought into the group boundary. By following these steps, you move from relying on management's word to relying on verifiable evidence, ensuring that no Project Oxygen or Element Alpha slips through the cracks.
All right, let's dive into this interesting case study. Imagine we have a newly qualified professional, let's call him Neon. Now, Neon is in that challenging initial phase of building his practice and taking on a few audits. To supplement his journey, he decides to use his fresh knowledge to provide online coaching to students. To get the word out, he starts advertising his classes across various social media platforms. The big question here is this allowed under the Chartered Accountants Act?
To solve this, we need to look at two different angles. First, let's talk about the activity itself. According to Regulation 190A of the regulations, a member in practice generally shouldn't engage in any business or occupation other than accountancy unless they have permission from the council. Now, here is the good news. The council has already passed a general resolution granting permission for private and part-time tutorship. So in terms of actually teaching, Neon is perfectly fine. He is allowed to be a tutor.
However, here is where the trap lies. We have to look at Clause 6 of Part I of the first schedule. This clause is very strict. It states that a member in practice is guilty of professional misconduct if they solicit clients or professional work, either directly or indirectly, through circulars, advertisements, or any other means. Now you might ask, why does this apply to coaching? Well, when Neon advertises his online coaching on social media, it is viewed as indirect solicitation. By promoting himself online, he is essentially advertising his professional profile, which is a violation of the code of ethics.
So, to wrap this up for your exam, remember this distinction. While the act of teaching is permitted under the Council's general permission, the act of advertising those classes is not. Because Neon used social media to promote his coaching, he has crossed the line into solicitation. Therefore, he is guilty of professional misconduct under Clause 6 of Part I of the First Schedule. Keep this distinction clear in your head, and you'll nail this topic.
Imagine you are the engagement partner at Neon & Co., and you've been brought in to review the interim financial information for Jupiter Global Limited. Now, since this is a recurring engagement, you aren't starting from scratch, but you can't just rely on old data either. Before your team jumps into the heavy lifting of analytical procedures and questioning the CFO, they need to refresh their understanding of the client's environment. According to SRE 2410, there is a specific set of steps the auditor must take to ensure their knowledge is current.
First, the team needs to do some reading. They should go back through the documentation from last year's audit, as well as reviews from previous interim periods of this year and the same periods from last year. This helps them spot any lingering issues that might still affect the current numbers. Next, they need to look at the risks. Specifically, they must consider any significant risks identified last year, including the ever-present risk that management might override internal controls. They should also review the most recent annual and comparable interim financial reports to see the bigger picture.
Now, let's talk about materiality. The team must consider materiality based on the reporting framework for interim information. This is crucial because it dictates how much evidence they need and how they will evaluate any mistakes they find. Along with this, they should look at any material misstatements that were corrected last year, as well as the ones that were left uncorrected because they were immaterial.
The auditor also needs to keep an eye on the big picture, accounting issues, such as any material weaknesses in internal control that are still relevant. They should also factor in the results of any audit procedures already done for the current year and review any internal audit reports to see what actions management has taken to fix problems.
Finally, we move to the inquiry phase. The team needs to have a direct conversation with management. They need to ask about the risk of fraud and how management is assessing it. They should ask about any changes in business activities and any significant shifts in internal controls that could impact the financial data. Lastly, they must understand the actual process used to prepare the interim information and whether the underlying accounting records are reliable.
All right, let's dive into this critical case study. Imagine we have a senior partner, let's call him Neon, from a firm called Planet Jupiter and Associates. Now, Neon found himself in a high-pressure situation while auditing a listed company. To meet some incredibly tight deadlines, he decided to use the company's own internal audit team to help with some of the substantive testing. Here is the problem. Because of the rush, Neon didn't strictly follow the standards on auditing. Now, the regulators are knocking on the door, and Neon is worried. He needs to know if his documentation is strong enough to prove he wasn't negligent.
If you are facing this in an exam, the core of your answer must focus on what an external auditor needs to document when they take direct assistance from internal auditors. To protect himself, Neon must ensure his audit file contains these 5 specific things. First, he needs a documented evaluation. He must show that he assessed whether the internal auditors were actually competent, and more importantly, whether there were any threats to their objectivity. You can't just trust them, you have to prove you checked them. Second, he needs to document the basis for his decision. Why did he choose this specific work for the internal auditors? He needs to justify the nature and the extent of the tasks he delegated.
Third, the review process. It is not enough to just get the work done. Neon must document who reviewed the work, when it was reviewed, and the extent of that review, strictly following the guidelines of standard on auditing 230. Fourth, he needs the paperwork. This means written agreements signed by both the internal auditors and an authorized representative of the company. This ensures everyone is on the same page regarding roles and responsibilities.
And finally, he must include the actual working papers prepared by those internal auditors. If the work isn't in the file as far as the regulator is concerned, the work never happened. So if Neon has these 5 elements, the evaluation, the justification, the review trail, the written agreements, and the actual working papers, he has a much stronger shield against charges of professional negligence. Keep these points in mind, and you'll nail this topic.
All right, let's dive into this interesting case study regarding professional ethics. Imagine we have a practicing chartered accountant, let's call her Neon, who operates an office in Mumbai. Now, Neon owns a domain name, and to make some extra money, she sells this domain to a company called Mars for a royalty of 2,25,000 rupees. Here is where the conflict arises. One of the directors at Mars claims that Neon has violated the code of conduct. Neon tries to defend herself by arguing that selling a domain name isn't a professional assignment, so she didn't need any approval from the institute.
Now let's look at the law to see who is right. According to Clause 11 of Part 1 of Schedule 1 of the Chartered Accountants Act, 1949, a member in practice is considered guilty if they engage in any business or occupation other than the profession of accountancy, unless they have received specific permission from the council. This is further reinforced by Regulation 190A, which strictly prohibits engaging in any other business or occupation without that official council approval.
Now, let's apply this to our scenario. Does selling a domain name for royalty count as a business or occupation? Yes, it does. Even though Neon argues it isn't a professional assignment, The law doesn't care if it's related to accountancy or not. The point is that she is engaging in a commercial activity for profit while practicing as a CA. Because Neon did not seek permission from the council before entering into this royalty agreement with Mars, she has crossed the line. Therefore, Neon is indeed guilty of professional misconduct under Clause 11.
The key takeaway for your exams is this. Any activity that falls under the definition of a business or occupation, regardless of whether it's related to your professional work, requires prior permission from the council. Keep this distinction clear, and you'll ace these ethics questions.
All right, let's dive into this important case study. Imagine we have an auditor, let's call him Auditor Mercury, who is conducting the statutory audit for a company called Mars, which manufactures floor tiles. The core question here is it appropriate for Auditor Mercury to ask the management of Mars about their own assessment of fraud risks and the controls they have in place to stop them? The answer is a definite yes, and here is how you should structure this in your exam to score full marks. First, start with the legal grounding. Refer to Standard on Auditing 240, which deals with the auditor's responsibilities relating to fraud in an audit of financial statements. Under this standard, it is clearly established that management accepts the primary responsibility for the entity's internal controls and the preparation of the financial statements. Therefore, it is absolutely appropriate for the auditor to inquire about management's own assessment of fraud risks and the controls designed to prevent and detect them.
Now let's add some depth to your answer. You must explain that the nature, extent, and frequency of these assessments vary from one company to another. In some organizations, management might perform detailed annual assessments or even continuous monitoring. In others, the process might be less structured or happen less frequently. Why does this matter to us as auditors? Because the way management handles these assessments is a huge clue regarding the entity's control environment. For instance, if you find that management has not made any assessment of fraud risk, it could indicate that they simply don't place enough importance on internal controls. That is a major red flag.
Finally, let's talk about the limitation of these inquiries. While asking management can give you great information regarding risks of material misstatement caused by employee fraud, it is unlikely to reveal fraud committed by management itself. Why? Because management is often in the best position to actually perpetrate the fraud. So, as a concluding point for your exam, emphasize that the auditor must maintain an attitude of professional skepticism. When evaluating management's responses, the auditor should not take them at face value, but should judge it necessary to corroborate those responses with other independent information. Keep this structure: standard reference, the appropriateness of the inquiry, the variation in assessments, the impact on the control environment, and the need for professional skepticism, and you will nail this question.
All right, let's dive into this important case study regarding the audit of a group. In this scenario, we have Mars, which is the subsidiary company, and Planet Jupiter, which is the parent company. Now, the auditors for Planet Jupiter are Element Gold and Associates, and the auditors for Mars are Element Silver and Associates. The core of this question revolves around Standard on Auditing 600, which deals with using the work of another auditor. The fundamental principle here is that there must be sufficient liaison, or coordination, between the principal auditor and the other auditor.
First, let's look at the role of the principal auditor, which in this case is Element Gold and Associates. There are three key responsibilities here. 1. They must issue written communications to the other auditor. 2. They should advise the other auditor about any matters that come to their attention which might have an important bearing on the other auditor's work. And 3. If they feel it is necessary, the principal auditor can require the other auditor to answer a detailed questionnaire to get the specific information needed to discharge their duties.
Now let's shift our focus to the role of the other auditor, which is Element Silver and Associates. Their role is centered around coordination and compliance. First, since they know their work will be used by the principal auditor, they must coordinate effectively. For example, they should immediately bring any significant findings that need to be dealt with at the entity level to the principal auditor's attention and strictly adhere to the audit timetable for the component. Second, they must ensure full compliance with all relevant statutory requirements. And finally, they must respond to the questionnaires sent by the principal auditor in a timely manner.
All right, everyone, let's dive into this important case study. We are looking at the appointment of Mercury and Company as the auditors for Oxygen Limited. The core of this question is about the auditor's role regarding the entity's compliance with laws and regulations. To score full marks here, you must structure your answer exactly as per standard on Auditing 250.
First, start your answer by citing the standard. State clearly that as per SA 250, consideration of laws and regulations in an audit of financial statements, the auditor must first obtain a general understanding of two key things. 1. The legal and regulatory framework applicable to the entity and the specific industry or sector in which Oxygen Limited operates. And 2. How the entity is actually complying with that framework.
Now move to the next critical point. You need to explain that the auditor must obtain sufficient and appropriate audit evidence regarding compliance with those laws and regulations that are generally recognized to have a direct effect on the determination of material amounts and disclosures in the financial statements. This is a key technical phrase, so make sure you use it.
Next, the examiner wants to see the specific procedures you will perform to identify noncompliance with other laws that might have a material effect. You should list these as two distinct points. First, inquire of management, and where appropriate, those charged with governance, to ask if the entity is in compliance. Second, inspect any correspondence that may exist with the relevant licensing or regulatory authorities.
As you move forward in the audit, remember to mention that the auditor must remain alert. This means that while performing other audit procedures, You should stay vigilant for any instances of noncompliance or suspected noncompliance that might come to your attention. To wrap up the evidence-gathering process, the auditor must request management and those charged with governance to provide written representations. These representations should confirm that all known or suspected instances of noncompliance, which should be considered when preparing financial statements, have been fully disclosed to the auditor.
Finally, conclude your answer by stating the ultimate objective. Mercury and Company is responsible for obtaining reasonable assurance that the financial statements, taken as a whole, are free from material misstatement, whether caused by fraud or error, while taking into account the applicable legal and regulatory framework.
All right, everyone, let's dive into this critical case study. We are looking at a company we'll call Mars. Now, Mars is a medium-sized player in the home appliance market. On paper, they look great because they have cybersecurity policies and frameworks in place, and management even does regular assessments. But here is the twist. Despite all those policies, they were hit by an email phishing scam. This led to money being sent to fake vendors, causing a huge financial loss.
As the statutory auditor, your job isn't just to check if a policy exists, but to evaluate if the controls around the electronic transfer of funds actually work in the real world. When you write this in your exam, I want you to maintain this exact structure. Start by acknowledging that cyber schemes often involve fraudulent requests for wire transfers, whether they are disguised as business transactions, vendor payments, or even requests from financial institutions.
To get full marks, you need to evaluate these three specific pillars. First, look at the human element. Ask yourself, are the personnel responsible for these wire transfers actually educated on the threats? Do they know how to spot a common phishing scam? If the staff isn't trained, the best software in the world won't save the company.
Second, focus on the authentication protocols. You need to check if there are defined steps to verify a request. For example, is there a callback procedure where the employee calls the vendor on a known number to confirm the bank details? Or is there a dual authentication process where two different people must sign off before money leaves the account?
Finally, look at the technical side. Evaluate the systems and technologies being used. You want to understand the entire life cycle of a transaction. How is the request initiated? How is it authorized? And how is the final release of funds handled? Keep this three-pronged approach in mind: education, authentication, and technology. If you structure your answer this way, you'll demonstrate a comprehensive understanding of cyber risk mitigation to the examiner. You've got this.
All right, everyone, let's dive into this important case study regarding professional ethics. Pay close attention to how we structure this answer, as this is exactly how you should present it in your exams to score maximum marks. The scenario involves CA Neon, who is contesting the Central Council elections of the Institute.
Now, CA Neon has engaged his articled assistant to help with his election campaigning. To motivate the assistant, he promises that this will provide networking opportunities with influential people, which will boost the assistant's career after training. We need to analyze this based on the Chartered Accountants Act, 1949.
Now let's look at the solution. The core issue here is other misconduct. First, clearly state the fact. CA Neon has engaged his articled assistant for his own election campaigning for the Central Council elections of the Institute. Next, you must cite the legal framework. This specific action falls under the category of other misconduct. You should mention that this is defined in Part 4 of the first schedule and Part 3 of the second schedule.
Now, here is the critical reasoning part that examiners look for. You need to explain that these provisions empower the council to take action, even if the misconduct does not arise directly from professional work. Why is this the case? Because a chartered accountant is expected to maintain the highest standards of integrity, not just in the office, but even in their personal affairs. Any deviation from these high standards, even in non-professional work, exposes the member to disciplinary action. To wrap up the logic, state that when a chartered accountant uses the services of an articled assistant for purposes other than professional practice, it is deemed as a violation.
Therefore, your final conclusion should be firm. CA Neon is guilty of other misconduct. Keep this structure in mind. Identify the act, cite the schedules, explain the principle of integrity in personal affairs, and then give your final verdict. You've got this.
All right, everyone, let's dive into this critical case study. This is a classic exam scenario focusing on the intersection of the Companies Act and the Chartered Accountants Act. Pay close attention to how we structure this answer, as this is exactly how you should present it to the examiner to score full marks. First, let's look at the facts. We have Mars, who is a director of Neon Private Limited. Now, the company appoints Venus, who is the spouse of Mars, as the statutory auditor. On top of that, Venus gives advice on issuing fresh equity shares and then signs off on audit reports for years without any disclosures. The core issue here is the eligibility of the auditor.
To answer this, we start with the legal framework. Under Clause 9 of Part I of the First Schedule to the Chartered Accountants Act, 1949, a member in practice is deemed guilty of professional misconduct if they accept an appointment as an auditor without first ensuring that the requirements of the Companies Act regarding such appointments have been complied with.
Now, let's bring in the specific restriction from the Companies Act. According to Section 141, subsection 3, Clause F, a person is simply not eligible for appointment as an auditor if their relative is a director or is employed as a director or key managerial personnel in that company. And remember, the definition of a relative explicitly includes a husband and wife.
Now we apply these laws to our specific case. Here, Mars is a director of Neon Private Limited. Since Venus is the spouse of Mars, he is a relative of a director. Therefore, Venus should not have accepted the appointment as the statutory auditor. To wrap up the conclusion, this is a clear contravention of Section 141, subsection 3, Clause F of the Companies Act, 2013. Consequently, Venus is liable for professional misconduct under Clause 9 of Part I of the First Schedule to the Chartered Accountants Act, 1949. Keep this structure in mind. First state the general rule of the CA Act, then the specific restriction of the Companies Act, apply it to the facts, and conclude with the liability.
All right, let's dive into this important case study involving Planet Moon Limited. This scenario is a classic example of how to handle untraceable liabilities and is a must-know for your exams. First, let's look at the core of the problem. Planet Moon Limited has a credit balance of 5 lakh rupees in its books. The company claims it is a very old balance and that the trade payable is neither traceable nor asking for payment. Because of this, the auditor cannot get an external confirmation. Also, note that there is no mention of any pending litigation here.
Now, when you write this in your exam, start by identifying the applicable standard. This is a clear case of external confirmation, which is covered under Standard on Auditing 505. Here is the step-by-step analysis you need to follow. First, acknowledge that since the identities of the trade payables are not traceable, the auditor cannot confirm the balance as it appears in the financial statements. Now, think like an auditor. Why is this balance still there? It is highly possible that an income of 5 lakh rupees was hidden in previous years. Therefore, the statutory auditor must examine the validity of this credit balance.
But how does the auditor do this? You must mention that the auditor should obtain sufficient appropriate evidence to support the balance. Crucially, the auditor should apply alternative audit procedures to find documentary proof for the original transactions. A key point for your marks here is that the auditor should not rely entirely on management representations. Management saying it is an old balance is not enough evidence.
Finally, if the auditor still cannot verify the balance after these procedures, the final step is the reporting. The auditor should include this matter by way of a qualification in the audit report addressed to the members. To summarize for your exam, identify SA 505, highlight the lack of traceability, suggest alternative audit procedures over management representations, and conclude with a qualified opinion. Keep this structure, and you will nail this question.
All right, let's dive into this critical audit case study. This is a classic exam scenario where you need to balance the technical requirements of IND AS with the practical application of Standard on Auditing 550. Pay close attention to the structure here, because this is exactly how you should frame your answer to score full marks. First, let's look at the facts. We are auditing Mars Supply Corporation, a government company. They've had a massive turnover of 12,000 crores. The core issue is that they bought spares worth 850 crores from another entity called Neon Procurement and Supply, which is also controlled by the government of India. The company didn't disclose this as a related party transaction, claiming that transactions between state-controlled enterprises don't need disclosure.
Now, how do we tackle this in the exam? Start your answer by citing the specific accounting standard. As per Ind AS 24, related party disclosures, there is a partial exemption. A reporting entity is exempt from the full, detailed disclosure requirements regarding transactions and outstanding balances when dealing with a government that controls them, or another entity that is also controlled by that same government.
But here is the catch, and this is where students often lose marks. This is not a total blanket exemption. Even if the entity applies this exemption, it must still disclose two critical things. First, the name of the government and the nature of its relationship, such as whether it is control, joint control, or significant influence. Second, it must provide information in sufficient detail so that users can understand the effect of these transactions. This includes the nature and amount of each individually significant transaction, or a qualitative and quantitative indication for those that are collectively significant.
Now bring in the auditor's perspective. According to SA 550, related parties, our job as auditors is to evaluate whether these identified relationships and transactions have been appropriately accounted for and disclosed according to the financial reporting framework.
Finally, let's apply this to our specific case. Mars Supply Corporation procured spares for 850 crores from Neon Procurement and Supply. Since both are government-controlled, the exemption applies, but the company still had to disclose the name of the government, the relationship, and the nature and amount of this 850 crore transaction. Therefore, the management's argument that no disclosure is necessary is simply not tenable. In your audit report, you must insist on these disclosures to ensure the financial statements are not misleading. Keep this structure: standard, exemption, mandatory requirements, and then application, and you'll nail this question.
All right, let's dive into this important question regarding the Business Responsibility and Sustainability Report, or BRSR. In this scenario, we are looking at Mars Limited, which is one of the top 1,000 listed entities. Because of the new SEBI reporting requirements, Mars Limited must disclose its performance based on the national guidelines on responsible business conduct.
The specific focus here is on a principle that states the primary purpose of any business is to create and provide useful products and services to the customer in exchange for reasonable profits. In your exam, you should identify this as Principle 9, which is provide value to consumers in a responsible manner. To score full marks, you need to present the core elements associated with this principle clearly. I want you to structure your answer using these 6 key points, as this is exactly how the examiner expects to see it.
First, the entity should transparently disclose all kinds of adverse impacts that their products might have on the user. Transparency is the key word here. Second, it is not enough to just disclose. The entity should actively make efforts to reduce the negative impact of their products and services on consumers. Third, the entity must inform customers about the safe ways of using and disposing of their products. This covers the entire life cycle of the product.
Fourth, when it comes to marketing, the entity must ensure that no misleading information is given to customers during advertising. Honesty in promotion is critical. Fifth, in this digital age, data is everything. Therefore, when handling customer data, the right to privacy of the customer must be strictly maintained. And finally, the entity should make available a transparent grievance redressal and feedback system. This ensures that the customer has a voice and a way to resolve issues. If you present these 6 points logically, you will demonstrate a complete understanding of how a company like Mars Limited provides value responsibly. Keep this structure in mind, and you'll nail this topic.
All right, everyone, let's dive into this important case study on professional ethics. This is a classic scenario that frequently appears in exams, so pay close attention to how we structure the answer to score maximum marks. First, let's look at the facts. We have a member, let's call him Mars, who is a practicing chartered accountant. Mars sent a letter to another firm of chartered accountants. In this letter, he claimed to be a pioneer in liaising with central government ministries and allied departments for getting clearances. To back this up, he provided a list of his existing clients and details of his staff.
When you write this in your exam, start with the legal provision. This is the most critical part. You must refer to Clause 6 of Part 1 of the first schedule to the Chartered Accountants Act, 1949. This clause clearly states that a member in practice is held guilty if they solicit clients or professional work, whether directly or indirectly. This includes solicitation through circulars, advertisements, personal communications, interviews, or any other means.
Now, to add more depth to your answer, bring in the Central Council guidelines for advertisement. These guidelines specify that a member's write-up should never claim superiority over other members or firms. Furthermore, it is strictly prohibited to include the names of clients in such communications.
Now, let's apply these laws to the facts of our case. In the situation with Mars, he sent a letter to another firm claiming to be a pioneer, which is a clear claim of superiority. Moreover, he included a list of his existing clients and staff details. These actions are indirect methods used to advertise his professional practice to gain publicity and solicit work.
Therefore, the conclusion is straightforward. Mars is guilty of professional misconduct under Clause 6 of Part 1 of the first schedule of the Chartered Accountants Act, 1949. Remember, students, when recreating this in the exam, follow this exact flow. First state the relevant clause, then the council guidelines, then apply those rules to the specific actions of the member, and finally give your conclusion. This structured approach ensures you don't miss any marks.
All right, everyone, let's dive into this important case study. Imagine a company, let's call it Mars Limited, which has been in the construction business for 25 years. Now, the management discovers a serious red flag. The building materials arriving at the sites are substandard, yet the accounts department is releasing payments that are way too high. This is a classic fraud scenario, and a forensic professional has been brought in to investigate. The core of this question asks us, what broad areas of information must be included in the final forensic report? When you write this in your exam, follow this exact structure to score maximum marks. First, start with the fundamental concept. Explain that issuing the report is the final, critical step of forensic accounting. The investigator must detail any fraudulent activity discovered. Remember, the client is looking for 3 specific things: the findings of the investigation, a summary of the evidence, a clear conclusion on the total financial loss suffered, and the identification of the individuals involved in the fraud.
Now let's break down the actual sections of the report. You should list these clearly. The report must cover the nature of the assignment, the scope of the investigation, the specific approach utilized, any limitations encountered during the scope, and finally, the findings or professional opinions.
To make the report professional and easy to understand, mention that it will include schedules and graphics. These aren't just for show. They are necessary to properly support and explain the complex findings. Furthermore, the report needs to go deeper into the how and why. It should discuss exactly how the fraudster set up the scheme and identify which internal controls were circumvented or bypassed to make the fraud possible.
Finally, wrap up your answer by stating that the investigative team will not just report the past, but look toward the future. They will recommend specific improvements to the organization's internal controls to prevent similar frauds from happening again. Keep this flow in mind. Start with the objective, list the structural components, explain the supporting evidence, and end with the preventive recommendations. You've got this.
All right, let's dive into this important case study. Imagine you have been engaged by Mars Limited to review their prospective financial information. This is a high-stakes scenario because the company is presenting these projections at a government investor meet to attract funding. As a professional, your goal is to determine the nature, timing, and extent of your examination procedures.
To score full marks in your exam, you must first anchor your answer by citing the correct standard. Start by stating that as per SAE 3400, which deals with the examination of prospective financial information, the auditor needs to consider several critical factors.
First, consider the knowledge you've already gained. If you've handled previous engagements for Mars Limited, that existing knowledge will shape your current approach. Second, look at management's competence. You need to assess whether the people preparing these projections actually have the skill and expertise to do so accurately. Third, evaluate the likelihood of material misstatement. Ask yourself, how likely is it that these projections are significantly wrong? Fourth, analyze the role of judgment. Prospective information is based on the future, so you must determine to what extent these figures are driven by management's subjective judgments rather than hard facts.
Fifth, dive into the sources of information. You need to check if the data management used is adequate and reliable. This includes looking at third-party data like industry statistics used to support their assumptions. Sixth, consider the stability of the business. Is Mars Limited operating in a volatile market or a stable one? This directly impacts the reliability of future projections. And finally, evaluate your own team's experience. Does your engagement team have the necessary expertise in this specific industry and the technical skill to report on prospective financial information?
All right, everyone, let's dive into this important case study. Imagine we have an engagement partner, let's call him Mars, who is conducting a statutory audit of a nationalized bank. Now, this bank uses a core banking solution, or CBS, and the identification of non-performing assets, known as NPAs, is entirely system-based, following the RBI guidelines.
Planet Mars wants to be absolutely sure that the internal controls are working effectively. He isn't just looking for a system that catches NPAs after they happen. He wants a system that prevents loans from becoming non-performing in the first place and sends out early warning signals if something goes wrong. He is placing a huge emphasis on credit appraisals and credit monitoring. If you are appearing for the exam, you need to structure your answer exactly like this to score full marks.
First, look for the use of third-party data sources. Why? Because the bank needs to perform comprehensive due diligence right at the sanction stage. This helps mitigate the risk of fraud or misrepresentation by the borrower. Second, check for the classification of accounts as special mentioned accounts, or SMAs. This is a critical control for the early recognition of incipient stress. By identifying these accounts early, the bank can take remedial actions before the loan actually slips into an NPA category.
Third, the auditor should look for the institution of a comprehensive, automated early warning system, or EWS. These systems have specific triggers that detect financial stress in real time, which significantly reduces the slippage into NPAs. And finally, look at the reporting of repayment behavior. The bank should report how borrowers are behaving in their loan accounts to credit information companies. More importantly, this information must be fed back into the credit appraisal and decision-making process before any further loans are sanctioned to those borrowers.
First, let's look at the core legal framework. You must start your answer by referencing Clause 4 of Part 1 of the Second Schedule to the Chartered Accountants Act, 1949. This clause clearly states that if an auditor expresses an opinion on the financial statements of any business or enterprise in which he, his firm, or a partner in his firm has a substantial interest, he is committing professional misconduct.
Now, we need to expand this using the Council General Guidelines. The guidelines clarify that a member should not express an opinion on financial statements if one or more of their relatives, as defined by Accounting Standard 18, have a substantial interest in that business, either on their own or together with the member.
Now, let's apply this to the facts of our case. Here, we have Mercury, who has been appointed as the statutory auditor of a private limited company. In this company, Mercury's spouse's sister's husband holds a 75% ownership stake. Now, 75% definitely qualifies as a substantial interest. However, the critical point of analysis here is the definition of a relative. We must check if a spouse's sister's husband falls under the definition of a relative, as per Accounting Standard 18.
When we examine the definition, we find that a spouse's sister's husband does not fall within this scope. So, to conclude your answer for the examiner, state it clearly. Since the spouse's sister's husband is not covered in the definition of a relative under As 18, the appointment of Mercury as the statutory auditor does not violate the rules. Therefore, this appointment would not amount to professional misconduct under Clause 4 of Part 1 of the Second Schedule to the Chartered Accountants Act, 1949. Keep this structure in mind. Start with the Act, move to the guidelines and the specific accounting standard, apply it to the facts, and end with a clear conclusion.
All right, everyone, let's dive into this important case study. Imagine you are the auditor for Mars Limited. The board of directors is worried because they've noticed a decrease in operating efficiency regarding material consumption. Essentially, they are seeing too much material going in and not enough finished product coming out. Now, before we jump into the solution, let's understand the core concept. Decreasing operating efficiency and material consumption is all about the input-output ratio. In simple terms, efficiency is achieved when we maximize the output using the minimum possible inputs, or when we minimize the input for a specific quantity and quality of output.
If you are asked this in the exam, you need to list the specific areas of focus. I want you to remember these 8 points, as they form the perfect structure for your answer. First, start with analytical procedures. You should compare the material consumption against the actual output for the current year and contrast that with previous years to identify the trend. Second, you must study the internal control system. You need to see if the rules and checks in place are actually being followed. Third, don't just look at papers. Have direct discussions and inquiries with the personnel of the company, especially the production team, as they are on the ground and know exactly what's happening.
Fourth, get into the technicalities. Study the production process, the scheduling, how the machines are being used, and the material mix being employed. Fifth, perform a variation analysis. You need to reconcile the differences and determine if the inefficiency is due to price fluctuations or quantity efficiency.
Sixth, look at the planning documents. Call for and study the budgets, the standard costing sheets, and other management information system reports. Seventh, leverage existing work. Thoroughly study the internal audit reports to see if any red flags, such as pilferage or fraud, have already been noticed. And finally, don't try to check everything. Pick key materials for a detailed deep dive study. Look at how they are ordered, how they are received, how they are issued to the floor, and check the normal loss yield percentage.
If you present your answer in these 8 clear points, you are demonstrating a comprehensive, professional approach to the investigation. Keep this structure in mind, and you'll nail this topic.
All right, everyone, let's dive into this important case study. Imagine we have a company called Planet X Limited. They've been trading in tires since 1995, but now they are expanding into manufacturing. They've imported machinery and are receiving government incentives like power and land subsidies. Element and Company has been appointed as the auditor. The core question here is, when auditing such a large entity, what substantive procedures should be performed to assess the risk of material misstatement?
Now, to answer this in your exam, you must start with the technical foundation. Refer to Standard on Auditing 330, which is titled The Auditor's Response to Assessed Risk. You need to define a substantive procedure clearly. It is an audit procedure designed to detect material misstatements at the assertion level. These procedures are broken down into 2 main categories: tests of details and substantive analytical procedures.
Let's break down the first part, tests of details. When you write this, explain that the design of these tests depends entirely on the nature of the risk and the assertion you are testing. For example, if you are testing for existence or occurrence, you start with the financial statement amount and work backward to find the supporting evidence. But if you are testing for completeness, you do the opposite. You look at items that should have been included and check if they actually made it into the financial statements. Also, remember to mention that when designing these tests, the extent of testing is usually determined by your sample size.
Now, let's move to the second part, substantive analytical procedures. These are most effective when you have large volumes of transactions that are predictable over time. The logic here is that relationships between data usually stay consistent unless something specific changes. However, you must mention that the suitability of a procedure depends on how effective it is at detecting a misstatement that could make the financial statements materially wrong.
To score those extra marks, provide a practical example. Tell the examiner that even a simple predictive model can work. For instance, if Planet X Limited has a fixed number of employees with fixed pay, the auditor can estimate the total payroll cost with high accuracy. This reduces the need for tedious tests of details on payroll. Finally, mention that using widely recognized trade ratios, like profit margins for retail entities, is a great way to support the reasonableness of the recorded amounts. Keep this structure: definition, tests of details with examples, and analytical procedures with examples, and you will nail this question in the exam.
All right, let's dive into this critical case study. Imagine you are the auditor. Let's call you Mr. Neon, and you are auditing a company called Planet X during your audit. you discover that the management of Planet X had a special audit conducted because they suspected some fraud. Now, as a professional, you need that report to ensure the financial statements are fair. But here is the problem. The management is ignoring you. They won't give you the report, and they won't even give you a written representation. This is a classic exam scenario, testing your knowledge of fraud and management integrity.
To answer this in your exam, you must follow a structured approach. First, start with the fundamental standards. Under Standard on Auditing 240, Mr. Neon is responsible for obtaining reasonable assurance that the financial statements are free from material misstatements, whether they are caused by error or fraud. Then, bring in Standard on Auditing 580 regarding written representations. You must explain that if management modifies or simply refuses to provide requested representations, it is a huge red flag. It alerts the auditor that significant issues might exist.
Now, let's apply this to our case. In the instance of Planet X, the management remained silent despite multiple reminders for the special audit report and the written representation. In such a situation, Mr. Neon cannot just sit back. He must take 3 specific steps. First, discuss the matter with management. Second, reevaluate the integrity of the management and see how this affects the reliability of all other evidence collected. And third, determine the possible effect on the final audit opinion.
Next, you must link this to the legal requirements under the Companies Act. According to Section 143, subsection 12, if Mr. Neon believes a fraud is being committed by officers or employees, he has a mandatory reporting duty. If the fraud amount is 1 crore rupees or more, he must report it to the central government. If it is less than 1 crore, he reports it to the audit committee or the board. Don't forget to mention CARO 2020. Under Clause 11 of Paragraph 3, the auditor must specifically report whether any fraud by the company or on the company has been noticed or reported during the year, including the nature and the amount involved.
Finally, wrap up your answer by discussing the extreme measures. If the suspected fraud creates exceptional circumstances that make it impossible for Mr. Neon to continue the audit, he should 1. Determine his professional and legal responsibilities regarding reporting to regulatory authorities. 2. Consider if it is appropriate to withdraw from the engagement. And 3. If he does withdraw, he must discuss the reasons with management and those charged with governance, and check if there is a legal requirement to report this withdrawal to the authorities. Keep this structure in mind. Start with the essays, move to the Companies Act and CARO, and end with the withdrawal process. This comprehensive flow will ensure you score maximum marks. You've got this.
All right, let's dive deep into this case study. This is a classic exam scenario where we are dealing with 2 critical issues: a massive tax litigation and a threat to the going concern assumption. As auditors for Mars Limited, we need to communicate these risks to the users of the financial statements using an emphasis of matter paragraph.
First, let's analyze the facts. Mars Limited is facing tax demands of 100 crores. Now, the management has played it smart by providing 50 crores in the books, but they are fighting the remaining 50 crores plus penalties. On top of that, the company is in a tough spot financially, with accumulated losses of 150 crores, equity of only 100 crores, and net current liabilities of 35 crores. This is a textbook case of material uncertainty regarding going concern.
In the first part, we address the tax litigation. Start by drawing attention to the specific note in the financial statements. You should state that there are income tax demands of 100 crores pending in various stages of appeals. Clearly mention that based on expert advice, the management believes no further liability, including interest or penalties, will devolve on Mars Limited beyond what has already been provided for. End this section by stating that pending the final outcome, no further adjustments have been made.
Now, move to the second part, which is the going concern issue. Again, refer to the relevant note. Highlight the financial distress, the 150 crores in accumulated losses, the 100 crores equity, and the 35 crores in net current liabilities. Use the technical phrase, and I cannot stress this enough. These conditions indicate the existence of a material uncertainty that may cast significant doubt about the company's ability to continue as a going concern. Then, you must mention the mitigating factors. Explain that the company's survival depends on establishing profitable operations and receiving continuing financial support from its key shareholders. State that because of these factors, the financial statements are prepared on a going concern basis and no further adjustments were made.
Finally, the most crucial closing sentence for any emphasis of matter paragraph. You must explicitly state, "Our opinion is not modified in respect of the above matters." This tells the reader that while these issues are important, they don't lead to a qualified or adverse opinion. Keep this structure in mind, use these precise technical phrases, and you will nail this question in the exam. You've got this. First, let's address the partnership aspect. According to Clause 4 of Part 1 of the first schedule to the Chartered Accountants Act, 1949, a practicing CA is deemed guilty of professional misconduct if they enter into a partnership, whether inside or outside India, with anyone other than another practicing CA or a person from a recognized professional body prescribed by the Council. You should mention that the Council maintains a specific list of qualified persons and professional bodies under the Chartered Accountants Regulations, 1988.
Second, we must look at the nature of the activity. Under Clause 11 of Part 1 of the first schedule, a practicing CA is guilty of professional misconduct if they engage in any business or occupation other than the profession of accountancy, unless they have obtained specific and prior approval from the council. This is a key point. Prior approval is mandatory.
Now let's apply these rules to our case. In this instance, Mars has partnered with people who are not members of the Institute to run a business. To conclude, since we assume that these partners are not recognized under the regulations, and that Mars did not obtain prior approval from the Council to engage in this business, he has violated both rules. Therefore, Mars shall be held guilty of professional misconduct under both Clause 4 and Clause 11. Keep this structure in mind. State the law for the partnership, state the law for engaging in business, apply it to the facts, and then give your final conclusion. You've got this.
All right, let's dive into this important case study. Imagine a scenario where Mars files a lawsuit against planet Jupiter for 5 crore rupees. Now, the legal counsel for planet Jupiter believes this suit is completely without merit. Because of this belief, planet Jupiter has decided not to create a provision, but has merely disclosed the existence of the lawsuit in the notes to the financial statements. As the auditor for planet Jupiter, your job is to determine if this treatment is sufficient.
First, start with the technical framework. Refer to Standard on Auditing 570, which deals with going concern. You need to explain that there are certain events or conditions that, individually or collectively, may cast significant doubt about the entity's ability to continue as a going concern. Specifically, mention that pending legal or regulatory proceedings are a prime example of such events, especially if a successful claim would result in a liability that the entity is unlikely to satisfy.
Second, explain the auditor's responsibility when a material uncertainty exists. If you conclude that the going concern assumption is still appropriate, but a material uncertainty exists, you must check 2 things. 1. Do the financial statements adequately describe the events casting doubt and management's plans to deal with them? And 2. Is there a clear disclosure stating that a material uncertainty exists, which might mean the entity is unable to realize its assets or discharge its liabilities in the normal course of business?
Finally, apply this to the specific case. In our scenario, Mars has sued planet Jupiter for 5 crores. While the attorney thinks the suit lacks merit, you as the auditor cannot simply take that at face value. You must evaluate the source data and the evidence upon which that legal opinion was formed. If your evaluation reveals a genuine uncertainty, you should request management to adjust the books by making a provision for the 5 crore rupees. Now, here is the critical part for your exam. If management refuses to make this provision despite the uncertainty, you must qualify your audit report.
All right, let's dive into this important concept regarding internal controls, specifically focusing on when manual elements are preferred over automated ones. Imagine you are in the shoes of planet Krypton. the engagement manager for Element Helium Limited. While planning the audit, Planet Krypton is looking at how the company identifies and discloses related party transactions.
Now, the key question here is, why would a manager decide to rely on manual controls instead of just trusting a computer system? To answer this in your exam, you must start with a strong foundational statement. State clearly that manual elements in internal control are more suitable in situations where judgment and discretion are required. This is the core of your answer.
Now, let's break down the 4 specific circumstances you need to list to score full marks. First, consider large, unusual, or non-recurring transactions. Think about it this way. A computer is great for repetitive tasks, but if a transaction is a one-off or incredibly complex, it requires a human eye to assess its nature and impact. Second, look at circumstances where errors are difficult to define, anticipate, or predict. Automated controls work on if-then logic. But if the error is unpredictable or doesn't follow a set pattern, a human's professional skepticism and judgment are far more effective.
Third, we have changing circumstances. Sometimes the business environment shifts so rapidly that the existing automated controls are simply outside their scope. In these gaps, a manual control response is necessary to bridge the transition until the system can be updated. And finally, remember that humans are needed for monitoring the effectiveness of automated controls. You cannot have a system that only checks itself. A manual review is essential to ensure the automated controls are actually working as intended.
When you write this in your exam, keep this exact structure. Start with the judgment and discretion premise, and then list these 4 bullet points. It's a clean, logical flow that examiners love. You've got this.
All right, let's dive into this important case study. This is a classic scenario involving auditor independence and professional misconduct, and it's exactly the kind of question that tests your ability to link the Companies Act with the Chartered Accountants Act. First, let's look at the facts. We have Mars, who is a director of Element Gold Private Limited. The company has appointed Venus, who is a chartered accountant and also the spouse of Mars, as the statutory auditor. Venus accepted the appointment and issued audit reports without any disclosures. We need to analyze this based on the Chartered Accountants Act, 1949.
Starting with the legal provision, you need to cite Section 141, subsection 3, Clause F of the Companies Act, 2013. This section clearly states that a person is not eligible for appointment as an auditor if their relative is a director or is employed as a director or key managerial personnel in that company. Now, it is crucial to mention that the definition of a relative specifically includes a husband and wife.
But we aren't just looking at the Companies Act. We are looking at professional misconduct. You must refer to Clause 9 of Part 1 of the first schedule to the Chartered Accountants Act, 1949. This clause states that a member in practice is deemed guilty of professional misconduct if they accept an appointment as an auditor without first verifying whether the requirements of the Companies Act regarding such appointments have been complied with.
Now, let's apply these laws to our specific case. Here, Mars is a director of Element Gold Private Limited. Venus, being the spouse of Mars, falls under the definition of a relative. Therefore, according to Section 140, of the Companies Act, Venus was ineligible to be appointed as the statutory auditor. By accepting this appointment, Venus ignored the statutory disqualification.
Finally, let's wrap this up with the conclusion. Because Venus accepted the appointment without first verifying if the statutory requirements were met, he has contravened the law. Therefore, Venus is liable for professional misconduct under Clause 9 of the first schedule of the Chartered Accountants Act. Keep this structure in mind: provision, application, and conclusion. It makes your answer precise and easy for the examiner to grade.
All right, everyone, let's dive into this important case study. Imagine we have an auditor, let's call him Mars, who is the auditor for Element Carbon Limited. Now, Element Carbon has come to Mars with a very specific request. They want him to perform a targeted exercise for the half-year ending September 30th, focusing solely on trade receivables. Specifically, they want him to check the arithmetical accuracy, obtain external confirmations, and ensure those confirmations are properly reconciled.
Now here is the core of the problem. Mars is in a dilemma. He is wondering if he can issue a report that provides an assurance to the company regarding these receivables. To solve this, we need to look at the nature of the engagement. First, let's analyze the situation. The process described here, verifying calculations, sending confirmation letters, and checking reconciliations, is essentially a fact-finding and reporting exercise. Mars is simply reporting the facts as they are. For example, he would state whether a confirmation from a specific debtor was received or not.
Now, this is where the technical distinction is crucial for your exams. You must remember that an assurance report is typically issued in the case of audit and review engagements. These are designed to provide comfort to the users of financial statements regarding the reliability of a specific assertion. However, the services requested by Element Carbon fall into a completely different category. These are classified under the related services domain, specifically as agreed-upon procedures.
Here is the golden rule for your answer. When a professional provides services under agreed-upon procedures, they cannot issue an assurance report. Instead, they can only issue a report stating the factual findings. They cannot provide any sort of opinion or assurance on the results. So, to conclude and guide Mars, the reasoning is clear. Since this is an agreed-upon procedure and not an audit or review, Mars cannot give a report providing assurance. He can only issue a factual report detailing the findings of his work. When you write this in your exam, make sure to clearly distinguish between assurance engagements and agreed-upon procedures. That is the key to scoring full marks here.
All right, everyone, let's dive into this critical case study. Imagine you are part of the engagement team conducting a statutory audit for a branch of a nationalized bank, which we will call Mars. During your audit, you notice a very suspicious pattern. There are a large number of cash credit accounts that remain only partially utilized for most of the year. But suddenly, in the month of March, these accounts become fully utilized. When you dig deeper, you find that these account holders used those funds to create fixed deposits right at the end of the year. To make it even more obvious, these deposits were liquidated in the first week of April of the next financial year.
Now, how do we handle this as statutory branch auditors? Let's break down the answer exactly as you should structure it in your exam. First, identify the core issue. This is a classic example of window dressing. The branch is essentially manipulating its books to artificially boost both its advances and its deposits. By encouraging customers to max out their loans to create deposits just before the year end, the branch is inflating its balance sheet to look more robust than it actually is. As an auditor, your primary responsibility here is to verify whether the unavailed portion of credit facilities, such as overdrafts or cash credits, are being used specifically to inflate these figures.
Now, let's look at the regulatory side. You must mention that relevant regulatory guidelines strictly prohibit such practices. In fact, this could lead to penal action under the Banking Regulation Act of 1949. Finally, let's talk about the reporting requirements, which is the most important part for your marks. You must do three things. 1. This situation needs to be suitably reported in your main audit report. 2. It must be commented upon in the long-form audit report, or the LFAR. And 3. Depending on the materiality and severity of the window dressing, you must consider making a suitable qualification in the main audit report.